Hello, this is Brenda Green, and I'd like to welcome you to our fifth presentation from Living in the Go. This one is entitled Investing is for You. I wanted to do this one for a long time because so many people that I know are really afraid of getting into that stock market. They're hesitant, they don't want to lose their money. And what I say to you is jump in with both feet because the water's fine. I've been investing for a long time and has been very successful for me and very helpful for me too. I've learned a lot, I've made some mistakes, but overall, I would say the experience has been very rewarding. So investing is just one piece of your financial plan. We've talked about many other things that you need to do, such as paying off your bills, investing in a house if that's what you want to do, and saving, having those different funds like emergency funds available. But this is one piece, and it's a vital piece, I think. So you may be wondering if you should invest, and I say yes, yes, yes. If you have a 401k, a 403b, or a TSP, that's a thrift saving plan at your job, then you're already investing in the stock market. Your company has selected certain funds for you, and they're putting your money in there. So shouldn't you know what's going on with them? Let's get started and let's talk more about investing. Now, the topics that I want to cover for you today are: what is the history of investing? Do you know what investing is really all about? The second thing, are you too emotional to invest? Well, I would say take the emotion out of it and think of it again as just one more tool in your financial arsenal. The third thing, what does diversity mean in investing? Do you know what diversification is? Diversifying your portfolio is what I'm talking about, and we'll get more into that. The last thing, do you follow the crowd? Can you do what's right for you and go your own path? Well, we'll talk about that too because it's important. Everybody's path is different. What you want to invest in, what you want to do with your money works for you, but maybe no one else. So be your own person. So what is the stock market? Well, the stock market has a rich history around the world. Its origin goes back more than 300 years, and it was really started in Europe before the Industrial Revolution. So that's a long time. The first stock exchange in London was created in 1773, and that was just 19 years before the New York Stock Exchange. But believe it or not, the first stock exchange in the United States was in Philadelphia, so they have that honor. But the New York Stock Exchange quickly became the most powerful one. The stock market is tied to American businesses, and American businesses have done very well over time. There are periodic setbacks that occur, but investors are really in the driver's seat with this because over time they have done extremely well. And it's really stacked in your favor because everything is tied to these businesses. If the businesses do well, then the stock do well. And as an investor, you do well. Now, the Dow Jones Industrials, and you've probably heard of that, or simply the Dow, it's a stock market index. It shows 30 large publicly owned companies in the United States. And believe it or not, when the Dow was first reporting, they were at a number of 65 in terms of points. Now they're at 11,497, and that happened over the 20th century. So a 100-year span, and look what it did. So again, you're in the driver's seat. If you have stocks and they're tied to these companies, you're going to do well. Now, the new kid on the block is the NASDAQ, and that was introduced as an electronic exchange, and it was competition to the New York Stock Exchange. The NASDAQ doesn't have a physical building like Wall Street. It's a series of computers that are set up to do those exchanges for you, and it was more inexpensive. It was easier to do, better to understand. So when the New York Stock Exchange saw how well the NASDAQ was doing, it created that competition and it made them improve on the processes that they used in Wall Street. So it was a good thing. Now the S&P, you may have heard that too. That's the Standard & Poor 500, and it has the list of companies from the New York Stock Exchange as well as the NASDAQ. So where should you be investing your money? Well, I say you should be investing in the stock market. The stock market crashes and it goes back up. It's proven itself that it can resurface time and time again throughout history and come back even stronger. There are powerful returns that can be had for that. For example, the Dow Jones Industrial Average typically averages between 10% to 11% annually, and it's done that over the last 100 years. I say that's an impressive stock market trend. They invest, reinvest, especially in the Dow, because they have what's called dividends. So if you own one of their stock, every quarter they give you a little something extra like a bonus, which is a dividend for being a part of their stock. So not a bad thing. And if you think about the stock in the Dow, and that's the Dow Jones Industrial, and you might have heard of some of them. That's American Express, Coca-Cola, Disney, Exxon, Home Depot, IBM, McDonald's, and that's just to name a few. So it's a great place to put your money and feel confident that it's going to do well. So you should have mutual funds, stocks, ETFs, which are exchange traded funds, as part of your portfolio. So people always think that they can get that next big stock. They get a tip and they think, I'm going to get rich. It doesn't really work that way for most people because we're amateurs. We're not the big gurus, and we don't have to be. We're investors, and we're investing in companies that have good business models, so we're going to do well. But you play for the long game and you invest smartly. You're putting your money into the stock market for your retirement. You're looking 20 years out, 30 years out. You want to make sure you're doing the right thing. Now, some people like real estate as an investment. I've never been one to want to have the maintenance and upkeep of having an apartment building, trying to collect rent and all of that, but some people love it. But if you do like real estate as an investment, but you don't want to do the dirty work, there are stocks that you can buy that are called REITs, R-E-I-T, REIT. And it's just real estate with investment. Let's say a developer wants to build a complex. He needs upfront money to get it going. So he will put shares out there for people to invest in. So you could buy those shares and you're part of the real estate without having to do the heavy lifting. So that's something you could look at as well. You can buy precious metals like gold, silver, and copper and add that to your portfolio, but you want to determine what percentage of those metals that you want to carry, because sometimes metals can be volatile. So again, do your research. Think about it. So investing is part of your money plan. I say this all the time to people because you want to invest in the stock market. You can save lots of money, certainly in a savings account, a money market account, or even a certificate of deposit, a CD. But the interest rates are very low. More than likely, they're anywhere from 1% in your savings account to maybe 4% in a CD. But the stock market can average 8 to 12% a year, so you do the math. You can buy stocks, bonds, mutual funds. Well, let's break that down and see what this all entails. So I mentioned earlier, if on your job you have a 401k, a 403b, or a TSP plan, then you want to contribute the maximum to that. There's something called compound interest that works in your favor when you contribute. And most of these plans, your company actually matches what you put into it. So that's free money. You want to make sure that you're investing and maxing it out fully. But again, in those funds, it's limited because your company will select stock that they want to put things into for you. And so you don't have a lot of say-so in terms of where the money goes. But again, free money, you want to do it. Now, if you don't have those vehicles at work, then I recommend opening up a Roth IRA at a brokerage company. And truthfully, even if you do have those plans at work, I still would open up a Roth IRA. And let me tell you why. I love the Roth IRA. It's a special retirement account that you fund with after-tax dollars. Keep that in mind, after-tax dollars. So as that fund builds and when you get ready to retire, guess what? Because it was funded with after-tax dollars, all of that money that you make and invest and it grows, It's free for you. You never have to pay taxes again on that money. So if you invest in a Roth and it goes up to $1 million, guess what? That's all your money, tax free. So I love the Roth IRA. Now, mind you, you can't do any tax write-offs on your income tax with it. But again, that's okay. Tax free. Keep that in mind. You also want to read some books in terms of investing, because when you get started, you might feel a little shaky, a little rocky. And there are basic things that you can do to get started. I recommend, again, the brokerage company. And there are lots of them out there. For example, you could go to TD Ameritrade, you could do Fidelity, Charles Schwab, E-Trade, Vanguard, just to name a few. You can make your own purchases, sometimes for less than $10 a share. And you want to trade on your own. You want to buy or sell, which is what a trade is. Because if you ask the broker, and they would be happy to do it for you, they're going to charge you a lot more money. I know at Fidelity, the trades are $4.99, and I use Fidelity. Love it. So you want to do your own trades. Now, if you really don't know a lot about investing, we can start with the basics. So a stock, which is also known as a share or equity, is a type of security, and it signifies ownership in a company. So it represents the claim that you have on that company's assets. If you buy a share, you own part of that company. There are two main types of stock. There's common stock and preferred stock. Preferred stock takes priority over common stock, and it's a lot more expensive to buy. Let me give you an example. Back in 1981, a share of Berkshire Hathaway preferred was $430. Today, that same stock is worth $319,000. That's the difference. If you can afford to buy a preferred stock, I say go for it, because the rewards are wonderful. But if you're like me, I have all common stock, which is great because I'm still doing well with those. The other thing is a bond, and I'll give you an example. Maybe your grandparents bought you a bond when you were a kid, and the face value on the bond said it was worth $25. But the reality is that your grandparents only paid $12.50 for that bond. And it has a maturity date on it, meaning that 10 years from the date that they gave it to you, that $12.50 will be worth that $25 that's on the face value of that bond. So that's kind of how bonds work. There are different types of bonds that you can buy. They don't grow as quickly as stock do. They're more stable. And sometimes people like having that stability. And that's okay too. You're still going to make money on it, just not as much if you would buy stocks or a mutual fund. You can get bonds which are called municipal bonds. You can buy into utility companies. You can buy bonds from the government. All those things are wonderful, and the interest rates will grow for you, but again, at a slower rate. And again, if you want that security, if you're hesitant, then that's a good thing to do. But you could add those to your portfolio for a good mix. Now, the next type is the mutual fund. And mutual funds are professionally managed. They have an investment manager who handles the pools of money from investors, and they buy securities or stock. But a mutual fund is different in that it buys a variety of stock all across different industries. So it might have technology stock, it might have retail stock, it might have manufacturing, it might have precious metals. They put a variety together so that if the stock market does fall, you have a better chance of it not impacting you in your mutual fund because it's spread out over so many different industries. So if the tech industry falls and you have a mutual fund that has a lot of variety, your other ones will shore up your mutual fund to make sure it doesn't go down too low. So it's always good to have those in your portfolio as well. But I will tell you, time is really on your side if you start early. The earlier, the better, because you have, again, that chance to have compound interest where your money continues to grow. And if you invest when you're young, you could be more aggressive because you certainly have more time for it to grow and go back up if it does go down. You also want to look at the annual returns because they will publish what their stock does from year to year. So when you're doing your research, you want to look at that particular stock and see what it did last year or 5 years ago. And remember that the returns that they show don't include the fees or transaction costs. So keep that in mind as well. There's a company called Morningstar, and you can go to morningstar.com to do your research. You type in the name of your stock, and it will show you the history. It will track back for you what it's been doing in that past year or what it did 5 years ago. So that's a way to do your research. Now, I talked about not being emotional about investing, but it is a tricky thing, and sometimes people feel about their money, certainly, that they don't want to lose it. So they do get emotional about it. And that's okay, but you should not let that be the reason that you don't get into the stock market. So I will tell you, don't try to forecast when the stock market will crash, because just know that it's going to happen. Over time, the stock market has crashed, but it has gone back up, and it continues to go up. In bull markets, and that's when it's doing really well, investors can sometimes find a good deal, but I'll tell you, when there's a bear market, when things are really, really low, that's the time to find some really incredible deals. If you're looking at a stock right now and you're thinking, and it's a bull market, so it's doing really well, and you say, I would love to have that stock, but I can't afford it. Well, when you have a bear market, when that stock goes down in price, that's the time to buy it. Buy as many of those shares as you can, because you know what? That stock will go back up and you'll make money. So that's a good thing. You don't want to be that person who liquidates their portfolio when there's a recession. Back in 2008, 2009, when there was a big recession, it was like really a depression. People got so nervous they were selling off all their stock and just wanted to hold on to cash. Well, guess what? The stock market came back with a vengeance, and it increased like 3 times over what it was. So people who stayed in made a lot of money. People who pulled out had to get back in, and they had to pay a higher price to do it. So don't be that person. You can buy stock when the market drops because you can get those good deals. And again, it's a win-win for you. Now, you want to remember that as an investor, you are a business owner. If you look at these businesses that you buy into, they have a good business model. They're going to do well. So remember, it's not necessarily the ups and downs of the stock that you're looking at, but it's really the company. If that company has that good business model, they're going to be okay. Just do your research and understand what you're dealing with, what you're putting into it. I know you might be afraid to invest, so I want to ask you to do a little list for yourself, a pro and con in terms of why you should invest and why you shouldn't. You need to figure out why you're afraid and find a way to move past that. Because again, I want you to be a part of the stock market. I want you to do well. I want you to be successful. Now, you can do what's called a risk assessment, and that will help set your expectations. A lot of the brokerage companies, when you go onto those invest, because I want you to get a Roth, but when you go in there to invest, they will ask you a series of questions to determine your level of risk. And if you're new to this and you're just starting and you're uncomfortable taking a big gamble, that's okay. But that way you can determine how much risk you're willing to take to get started. So those are the things to help you move beyond that emotion and really start to invest and feel good about it and feel confident in yourself. I know you can do it. Now, I talked about diversifying your portfolio. And what I mean by that is that you should have a combination of items in your stock portfolio. So again, stocks, mutual funds, bonds. Now, another thing that you could do is to do your research around that stock. So you may get a tip from somebody that you really trust, but again, do your homework and look at that stock and see if that's something that you want to add to your portfolio. There's another thing called index funds, and they're pretty simple and inexpensive. An index fund is a mutual fund, and it invests in stocks that are typically included in the S&P or the Standard & Poor's 500. So now index funds, they have a fund manager as well, But this person's job is much easier than that of a fund manager for a mutual fund, because the fund manager of a mutual fund, they handle more volatile investments in their portfolio, so a lot bigger job. But the index funds, they don't rely on managers to pick the stock. They tend to follow the moves of the larger market. So whatever the S&P or the Standard & Poor's is doing, they tend to look at that and they make their decisions based on what's happening with that. So again, easy, simple, and they do pretty well. You need to get organized and have a plan of what should be in your portfolio. So when you're looking at diversifying, pick the different industries that you want to be involved in. And again, look at their track record. A good financial plan protects you against those torpedoes that could sink your ship. I'm not saying you're not going to have those downs, because you will, but you don't want to lose everything. And by being diversified in your portfolio, that ensures that you will be successful. Now, do you follow the crowd? And what I mean by that is, can you stand on your own and make decisions that work best for you? Don't be impressed by that short-term success. I will say, remember the tech bubble. And for people who don't know that or weren't around during that time, well, I'm older, so I was around. So the dot-com bubble, also known as the tech bubble, it was an internet bubble. And people were buying tons of technology stock. It was around 1995 to 2000, and there was extreme growth. I mean, everything people touched in the technology sector just grew like crazy, and people were just buying out. I mean, just buying, buying, buying. They were doing no research. They weren't looking at these companies, and these companies were coming out of nowhere. Overnight, a company would create itself and put stock out there for people to buy, and people were doing it. They weren't researching. They weren't even thinking logically. They were thinking, I'm making money. So everybody was buying and getting these ridiculous returns, and these new companies were going public left and right. People weren't doing that due diligence. They were seeing dollar signs and thinking it was the best stock ever. Well, the stock market crashed big time, and with it, people lost everything. They were devastated. Investors lost lots of money with these startup companies. And a lot of these companies went out of business. Remember what I said about researching the company and looking at their history and if they were successful and have a good business model? Well, people weren't doing that with the stock market for the technology bubble. They were just looking at dollar signs. Don't do that. Do your homework. Again, look at those annual returns for the stock or that mutual fund that you want to buy. And you want to ignore the noise. When you hear that some company is doing extremely well, you've never heard of the company before, people saying, buy that stock, ignore that. You want to make sure you do your homework and your research, because again, things go up and down. And if you're taking a risk on a company that nobody knows anything about, that's not a good move, because we're amateurs when it comes to dealing with the stock market. So as an amateur, you want to just be a little cautious and make sure you're making the right moves. Now, bad financial events, they show up. Set your expectations that the market will rise and fall, and have a good plan for the long haul. This is not the short game. This is something for your future in terms of retirement. So you're thinking 20 years, 30 years out. Don't be intimidated by that, but make good decisions. When I say don't go with the crowd, I want you to think for yourself. If something just doesn't feel right to you, don't do it. Don't compare your portfolio to anybody else's. Your income may be different. Your capacity for risk may be different. There are a lot of different factors to consider with that. So don't get caught up in that near-term economic forecast that people talk about. You see it in the headlines all the time, and you think, oh my goodness, I want to be involved in that. No, you don't. You're an investor. You're not a trader. A trader is a person who professionally buys and sells stock. That's not us. We're amateurs. We're just investors. So spend time planning for where you want your portfolio to go. Have a goal in mind and work towards it, because a good plan prepares you for some risk, because we all know it's going to happen. No matter how smart, educated, or talented, we can be fooled. So be cautious. Also, age plays a factor. The older you get, the less risk that you want to take with your money. So again, do your homework, do your research. Now, as always, I have Brenda's beliefs. And again, these are just things that I'm thinking about. You can take it with a grain of salt. You don't have to follow them, but these things work for me. Don't put all your eggs in one basket. Make sure you diversify. Don't believe anyone who tells you that getting rich is easy, because if it was, everybody would be doing it. Don't get emotional over investing. Again, it's a part of your plan, and you have a plan for the long haul, and if you do that, you'll be okay. Don't invest with your insurance agent. He's selling products. It's his job to get you to buy the different products that he has, telling you how that's going to help you in your future, help you with your retirement. I say no to that. And I love my insurance agent, but I don't buy products from him. He makes a commission off of those. I don't want to buy a product where I'm paying someone for that product. I'm giving them a commission. I want to keep all of my money, which is why I invest in a brokerage company. It's okay to say I don't know, because again, we're amateurs, we're not experts. So you want to ask for help if you need it. Overconfidence leads you to be vulnerable. So stay humble and always in that learning mode. Again, smart people can be fooled. If it seems too good to be true, it's probably not. Rule number 1 is to never lose money you need to pay for your necessities. Rule number 2 is to remember rule number 1. Don't compare your efforts to someone else's success. You don't know what their strategy is, and it might not be right for you. I say that all the time. It's important. So in summary, gain as much knowledge about investing as possible. Read and ask lots of questions. Take the emotion out of investing and think of it as just one more piece to your financial plan. Diversify your portfolio and put it on autopilot. Read the fine print on all your transactions, and identify specific actions or tasks you'll take to start investing in the stock market. Don't be a follower when it comes to investing. Track your progress, but not every day. That'll make you crazy. If you're out there looking at the ups and downs every minute, give yourself some time. Step away from it. And last but not least, I just want to thank you for your time and attention. Hopefully you got something out of this, and I would love to get your feedback. So feel free to put some comments on the page for me, and also subscribe to my YouTube channel so that way every time I put something out there, you'll be notified. Thank you.